Ed Morse, you think that the market is misled in thinking that the current disruption in the oil markets from the Middle East is going to be short-lived? Do you think it's going to be longer than that?
Yeah, I think the market is, to the degree it believes that, is misperceiving two critical elements. One is a physical one of Libya, and if there were peace tomorrow, whether Libyan production could be restored overnight. And I think we're talking about at least a year before Libya can get people back and get the technical requirements in place to get 1.5 million barrels a day of oil flowing again. And the other is that I think we now move to a situation in which, given the socioeconomic factors behind the political movements taking place across North Africa, across the Middle East, and I dare say in Venezuela, Ecuador, and other oil-producing regions in Latin America, but the move toward participation and decision-making in countries that have huge income disparities, I think that says that there's going to be a risk of another kind of market distortion or disruption at any moment in time, and I think that will be priced into the marketplace.
You call this the new geopolitics of oil, something like this, and you think it's going to go on for some years, right?
Yes, if you look at the causes of what's going on, the causes are domestic and internal, and they could erupt at any moment in time, to the degree that governments in oil-producing countries try to do what they can to prevent these kinds of conditions from becoming civil disorders or even civil wars, or the ousting of leadership. These governments are going to be materially increasing the benefits that they bring to their populations. They will therefore be requiring higher and higher oil prices. They will also be subsidizing and continuing to subsidize domestic energy consumption, which means that unless a government can rapidly increase production, they're going to see shrinking export surpluses. So that too will lead to a tighter market, and this is the new reality of the marketplace. And I said, you know, maybe it lasts a decade, maybe it's going to be 8 years, maybe it'll be 20, but it will certainly be here for a long enough period of time that it will have to be taken into account in the marketplace and by policymakers.
Market traders talk a lot about spare capacity. Where are we at with spare capacity, and are you worried about it?
Yeah, market doubters, skeptics about OPEC countries' ability to produce, or people who are peak oilists and are peak oilists to the core and won't give up on their peak oil theories, refuse to think about Iraq raising production, which it's already done. They're up 300,000 barrels a day since December, and they'll continue to rise it this year, next year, and the year after. But they're also doubtful about Saudi Arabia either having current capacity or building more capacity. And I'm not a doubter on that. I think the Saudis have a good 12.5 million barrels a day of production capacity that could be used today or tomorrow, and they're producing maybe 9.3 or 9.5, so they I think have 3 million a day of spare capacity. I think they could bring on another million in a year, and I think it's clear to me that Kuwait has about 1 million of spare capacity, and the UAE has 400,000 or 500,000 of spare capacity. So that would save 4.5 million barrels a day, enough to satisfy a couple of years of demand growth, even if OPEC were the only ones who were contributing to supply growth, and non-OPEC were to do nothing.
Well, so what about when these skeptics add up the volume of spare capacity and then volume demand growth over the next couple of years? They say, okay, we're going to have 1.2 demand growth this year, 1.2 million barrels a day next year. You take Libya off the market, and pretty soon the spare capacity is eaten up. Do we have a supply crunch coming 3-4 years down the road?
We might 3 or 4 years down the road, and we might, ironically, partly because of the moratorium on drilling imposed by the U.S. In the Gulf of Mexico, because that, if you look at where oil production might have been by 2016 as opposed to where it looks like it will be in 2016, there's a big wedge. The wedge is somewhere between 2 and 3 million barrels a day. So I'm doubtful that we should be fully confident about the middle years of the decade, but I am much more optimistic about the end years of the decade, because I think the high prices that we saw in the last decade have already facilitated capital going into the sector, which will bear fruit in the decade ahead.
Okay, one more question, Ed. When oil people talk about Iraq, they talk about the contracts that have already been leaded that require 12 million barrels a day of production by the year 2017. But one of the things we've heard at the conference here is that the market, there might not be market demand for this 12 million barrels a day, which flies in the face of again, these skeptics talking about a supply shortage. So what about, are we going to have those 12 million barrels a day, and can the market absorb it if we do have it?
Well, to the degree I'm a skeptic, it's about the 12 plus million barrels a day coming out of Iraq. On the other hand, Iraq is going to be producing a lot more oil than it's currently producing. I would be surprised if it were not producing 5 or 6 million a day by then. That's a lot of oil, even at this half a level of 12 million a day. It's a lot of oil for the market to absorb. And I think the issue to be confronted is whether Iraq, as a relatively low-cost producer, will be a volume maximizer, or whether it will follow the course of OPEC as a old member of OPEC and agree to production cuts in order to put a floor under prices. So that's the issue that remains to be seen in my mind.
All right. Thank you very much, Ed Morse.